Good evening, folks. So this is the beginning of our YouTube channel. I'll be doing live trading and back testings on weekends, and I don't know, giving out psychology tips. I'm not in a position where I will say that I'm profitable, but I think I am somewhere where I think I need to share my knowledge with some of you. So first and foremost, I'm going to start with the Asian session trading. Let me see. What's wrong with this? Asian session trading. So Asian session, this is a session where the US banks are closed and most banks that are working, the Japanese yen banks and stuff, but we are trading futures, so we can also work with this. Asian session, I have a specific model I use for the Asian session, and Asian session trading starts after 7. Market opens at 6. After market closure in the PM session, market opens at 6. But for Asian session trading, for me to place a trade, I have to place a trade after 7. So that's one of the rules I follow before trading the Asian session. So what I'm looking for, I want market to take out subsequent minor buy side sell side liquidity before I enter a trade. So for me to look for a model, so after market opens or before market opens, if you're doing prior analysis, before market opens, I'm looking for minor buy side. So minor buy side, these are highs that, okay, the liquidity that is nearest to the start of the market, if you feel me, if you understand. So it doesn't need to be a major high or a major low. That's why I'm saying it is minor buy side or minor sell side. So I have this, if I am to treat this as my minor sell side liquidity, and this low at 23200, this is minor sell side liquidity. I wouldn't want to mark this as something large because I don't want my eyes to be so focused on it. Then I have my minor buy side. I have my minor buy side liquidity. So what I'm looking for, I would want market to take out one of these for me to start creating a trade. So most of the times what disturbs traders is you treating things as patterns. So there is an error in trading where where this support and resistance used to work, the triangles and stuff, but some things changed and you have to see trading in a different perspective. So this thing, you have to have an intellectual thinking about it so that you're not stuck looking for something that looks the same every day, because market gives opportunities every day, a lot of opportunities, but it's not like they will be like twins identical every time. So you have to be able to adjust to any price action that is brought to you. That's why I do this backtesting, so that I can see and be exposed to a lot of market structure. So I'm having minor buy side and my minor sell side. What I see market taking out before 7 p.m. market comes and takes out minor buy side. So I'm having this fair value gap, and I'm having that fair value gap. I'm looking at that to see the price action that's happening in it. So a move that takes out minor buy side and delivers back into the new day opening gap. So the gap that is between the closure of the market at 4:59 and 6 market open, that is the new day opening gap. So a move that delivers and takes out minor buy side liquidity and comes back to the new day opening gap, the high or low that supported that move is going to be marked as initial buy side or initial sell side, and initial buy side or initial sell side will be used throughout the day, and I would want to use it mostly when I'm trading the AM session. We shall get back to that. So I'm looking for a move that trades back into the new day opening gap. So I have this move that takes out this minor buy side but does not come back into the new day opening gap. So why this move doesn't come back into the new day opening gap, we have this fair value gap that forms at the when the market opens. So this will hold the market until it is disrespected. Then market will push lower for lower interests. So I'm working to mark out this from this high to the start of the new day opening gap. So I want to consider the whole of this plus the new day opening gap as one gap. You understand? But I won't be doing that because this fair value gap and the new day opening gap will all deliver different price actions. So I would want to see the different levels in each and every one of them. So I wouldn't draw one box to have one consequential approachment. I would want to have both. So this fair value gap, as long as it is not broken, it will hold market until it is broken. So we come, it holds the market. Then we get a move that delivers to the new day opening gap. I'm not looking about executing this way up because I would want to execute at the new day opening gap most of the times, because that would be the highest probability trade. So I have, if I'm to tape read this consolidation, so we have market taking out subsequent liquidity, and now this move that takes out this high, this is a turtle soup. That is a turtle soup entry. That would be a turtle soup entry, but this entry is sophisticated and not easy to cope with. But if you master it, then it is a good entry to have, a turtle soup entry. But I would want to consider this. I would want to consider this high and this high to know that market has taken out subsequent liquidity, and now we are looking for lower prices. So if market continues taking out liquidity, I'm not going to be a participant of any of these. Looking for the new highs, I would want to see market going higher so that I can get a move that drops to liquidity below without me worrying about liquidity higher. So if I'm to look at ES, because this is NQ, if I'm to look at ES, you're going to find out that we have this high on ES higher than this high, and on NQ the high that we have on ES that is higher is lower. That means this is SMT. That means we're having SMT at these highs. We're having SMT right there. SMT on NQ and ES. So I would look to that as confluence also. This is my SMT. So we drop lower, leaving a breaker. So let me say it is high, low, high, low, high. So we drop lower, leaving this as a breaker. This as a breaker block. So I would consider this as a breaker block right there, a bearish breaker block. So I would want to execute, because we'll reach to the new day opening gap, then market comes back higher. So this is a secure entry. If you wanted, you would have executed on the breaker looking for lower prices. So I would have had it as this, placed my limit at the breaker, my stop loss being this last up close candle in this move. This would have been my stop loss right there, and then aiming for lower prices. That would be entry number 1 on the breaker. If you didn't take the entry of the breaker and you had this idea of this gap being closed below or disrespected before you took your entry, then you would have had this gap being disrespected, market coming back into it, and your stop loss being at the high of the second candle that formed the fair value gap. So this would be your entry. This would be a high risk entry. You would have had it like that. That would have been your entry, looking for sell side liquidity. That is entry number 2. So entry number 3 would have been, in the Asian session, we normally focus on the volume imbalances. So you have to incapacitate the volume imbalances with your trading. So a volume imbalance that is next or inside or in the new day opening gap is a high probability volume imbalances, and I would treat it as a gap for my entry. I would execute on the volume imbalance. So this volume imbalance is right at the consequent encroachment of this new day opening gap, this red line, and market leaves and closes below it. So it holds the market first, then market drops and disrespects it and closes below it. So I would also execute that volume imbalance. So we are so far looking at entries, and my stop loss would have been at this high, then targeting this, something like a 1 to 2.5 or 3. That would have been nice. So we are so far looking at entries. We are going to come to exits. So those are the number 1 entries I would have taken. I wouldn't have taken this because there is no confluence. This is a fair value gap. Market does not come and trade back into it. I would want it to stay open because it is a breakaway gap. I would want to stay it open and we keep this volume going down. So for the exits, I would want to look at the standard deviations of this move that comes back into this breaker. Now if I get my fib from that high to that low, use the expansions to target a 1 or a 1.5 trade, that would have been my exit. So that's exit number 1. Exit number 2 would have been this manipulation that takes out this high. So I would be looking for the 2 standard deviations, as I can consider this as a change in state of delivery on the higher time frame, and for a move lower. That would have been exit number 2. So if I get from this high to the start of this move, how far can market go? below that. So let me see. So from this high to this low, how far can market go below it? It can go to negative 0.25. So I save that as the extrapolated low and high. You can see that level. Most of the times, if you're to take your take profit to a level of liquidity, most of the times market will go further to this level of 0.25, and that is not random. So that would have been exit number 3. So thank you. Have a good day.